So what can happen if this scenario develops, that over some months it becomes clear that Greece needs to leave the Eurozone? Basically, we have two scenarios. In our central case, where you only have 0.5% negative growth in Eurozone this year, and next year relatively weak growth in the Eurozone, that's the more positive scenario, where we think the Greek exit, and Greece is only 2% of Eurozone GDP, the Greek exit doesn't have a lot of contagion to the rest of the Eurozone because they prepare correctly for it, they undertake sufficient measures to create firewalls and prevent a run on the banking system in countries of Southern Europe. And that's the greatest risk of all. There's a lot of risks around this, but the great concern is what will happen when people realize that the Greeks will have to go back to the drachma. Obviously, for the Greeks, they're already starting to take out their money from the banks at a relatively slow pace. But nevertheless, there is clear signs that there is a drain on the banking system because they're taking out their euros, fearing that they'll turn into drachmas relatively soon. If there's contagion, that people in other countries in Southern Europe fear the same thing is happening, then of course you could get runs on the banks in other countries too. So a key measure that will be necessary is for the Eurozone governments to create a clear firewall to prevent that contagion. And if they say, well, Greece is out, that they need to reassure other depositors in other European countries that they're not next on the list. And so, of course, banking system guarantees, but maybe more than that, because it's not just about deposit guarantees, but also about guarantees that they'll still have euros. These are necessary to prevent runs on the banking system that could be extremely costly in terms of the cost of bailing out and solvency issues. So that's the positive scenario, that they create firewalls and prevent the contagion. The more scary downside scenario is if you have a meltdown situation where the governments don't take sufficient measures and you get an escalating crisis in the Eurozone because you get banking system runs, and then the cost of recapitalizing the banks, of the European governments and ECB stepping in to pump money into the banking system becomes extremely high. In that kind of scenario, the global contagion risks are also much more relevant because you could get a more severe, I think you will have a deeper recession in the Eurozone over the next 12 months if you do get those kind of banking runs. Clearly, you'll get panic in financial markets in that scenario if people are withdrawing money in the banks of Spain, Portugal, Ireland. And all of this means that it would have a very negative impact on Asia because European GDP, instead of being -1 or so, might be more -3, -4. These kind of numbers could happen in a meltdown scenario. Maybe not for 2012, but probably for 2012, 2013, over a 12-month period. And that could very much escalate the shocks to Asia in terms of trade finance, because obviously European bank deleveraging would be much more vicious in that kind of scenario. And you'd obviously have many other transmission effects as well, because you wouldn't get the capital flows from Europe in the same way coming into Asia. Demand for Asian exports would fall and so on. So the meltdown scenario definitely is very ugly. Right now, we don't think that that would be the likely scenario. Our probability of the meltdown is still relatively low, maybe about 20% or so. But I think it's an important risk to be concerned about. And then the key, of course, is how can the Eurozone over the medium term emerge from this situation? Even if you have this crisis management in an effective way, the situation is still very grim, that in some of the countries of Europe, unemployment rates are very high. Obviously Spain, Greece, Portugal also has relatively high unemployment rates. But this is not the same everywhere. I mean, Germany actually has the lowest unemployment rate, 6.8%, the lowest for 20 years since unification between East and West Germany. And business confidence at the moment in Germany is actually rising. It's at a 9-month high, and their exports are benefiting from the weak euro. So it's not the same problem throughout Europe. You've kind of got a 2-speed, maybe 3-speed Europe, with Northern Europe still doing relatively well in most cases, held together by Germany. But clearly the problem over the medium term is that strong wage growth in some of the southern European countries has hurt competitiveness, and trying to reform that through all the reform programs that are underway right now in Italy, Portugal, Spain, and Ireland is going to take quite a long time. This cannot be done in a year or two, and the problem is for the countries to somehow get through that restructuring period through very difficult economic times. When you have recession, it's very hard to do these reforms, as we can see. So we still feel that the situation remains extremely difficult over the medium term, and that the Eurozone will be facing a period of protracted weakness for some years to come. And as you can see, the crisis involves a number of different aspects of the economy. Sovereign debt burdens obviously are very high throughout much of the Eurozone, and certainly in the crisis countries remains a very big problem. Even in Spain, where the debt to GDP ratio has been relatively low, I would say, it has been rising very rapidly. This recapitalization will push it even higher, and the outlook is that it will rise even further. So what started off as a relatively good debt to GDP ratio at the beginning of the Eurozone crisis for Spain has now deteriorated substantially. The banking system we've already talked about, that there's obviously very big problems still in southern European banks, and the economies face years of hardship. And we've talked a little bit about how these problems can be transmitted to the rest of the world, but I think in particular the European bank deleveraging remains a key risk. Back in August, September last year, we had one round of very significant bank deleveraging, which had the risk of hurting Asian trade finance. In the end, it didn't, because Asian banks were able to step in and pick up the slack. But if we enter a more severe down phase in Europe with another round of deep deleveraging in an environment where the global economy is facing much greater risks to the outlook, given what we're seeing right now, the other banks in the world, the Asian banks or US banks, may be more cautious about filling that gap. So I think the risks related to trade finance, to global credit, remain very significant. And in the meltdown scenario, clearly a big risk is that you get a repeat of what we saw in 2008 with a shuttering down of credit markets in Europe. If you've got a situation where there's runs on banks, counterparty risk again escalates as a key concern, and you could well face, at least within Europe, a shuttering of credit markets again if there's not sufficient measures by the Eurozone governments to create firewalls. And I think Greece, how can they come out of this mess? If they stay with the euro, I think it's a very, very hard process for them to get out of this situation. GDP has been falling, by 7% last year. We expect this year will be minus 6% GDP growth. Unemployment, as I say, about 1 in 4 also in Greece, and youth unemployment there's also over 50%. So how can this country emerge when they still seem to be spiraling downwards? So I think there is a very severe risk that they will have to exit from the Eurozone. And if their vote, as it looks like will be on this weekend, is going to be against further reform measures, then I think there's a high risk that they may eventually have to exit the Eurozone. So I think in summary that there's a lot of uncertainties facing the global economy. The biggest risk is definitely the Eurozone right now, the way we see it. But in our central case, we still think the Eurozone governments can put together sufficient measures to at least stabilize the situation, even if there is a Greek exit. But a lot will depend on the ability of the Eurozone governments to come together and put together a credible package to boost financial markets' confidence. And certainly this step towards recapitalizing the Spanish banks was an important part of that overall process. I'll stop there just to allow time for a couple of questions. I think we're going to have a panel discussion later, so there'll be more time in that for more questions. But if there's a couple of burning questions now, I'm happy to take them. Thanks.